Sandy, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamowen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Sandy, all right, Steve, let's start with our first topic today, which is about Ontario's mortgage crisis extending beyond Toronto. It seems like this issue is much more widespread than many might have thought.
Steve, absolutely, Sandy. A new report from the Fraser Institute shows that mortgage payments are consuming more than half of the median after-tax family income across all 14 of Ontario's largest urban centres. Toronto is leading this with a staggering 110.2%.
Sandy, that's a huge number, Steve. I think there's been a perception that moving outside of the Greater Toronto Area would offer some relief in terms of affordability, but this report really challenges that notion.
Steve, you're right. Austin Thompson from the Fraser Institute pointed out that even in places like Windsor and Kingston, families are spending more than half of their after-tax earnings on mortgage payments. It's a significant shift from where things stood in 2014.
Sandy, and it's not just a minor shift, Steve. Back in 2014, Windsor was at 21.1% and Toronto at 56%. Fast forward to now, and Windsor has more than doubled to 63.2%, while Toronto has jumped to 110.2%. It's clear that the crisis has spread well beyond the core metropolitan areas.
Steve, exactly, Sandy. And the mortgage delinquency rates are climbing too. Ontario's rate has overtaken the national average, reaching 0.23%, and Toronto's rate jumped significantly in just a year.
Sandy, it's a worrying trend, Steve, and it seems wages just haven't kept up with these rising home prices. Stephen Globerman from the Fraser Institute highlighted this wage price gap as a central issue.
Steve, that's right, Sandy. Globerman suggests that to improve affordability, policymakers need to focus on increasing wages and incomes, not just on the supply side of housing. It's about finding a balanced approach.
Sandy, and that's a shift from what we've been hearing, which often focuses solely on increasing housing supply. But clearly, income growth needs to be part of the solution too.
Steve, indeed, Sandy. There's also a broader implication here. With mortgage payments taking such a large part of household income, it affects Ontario's labor market competitiveness. It makes it harder to attract and retain talent in the province.
Sandy, in light of the recent TD survey, it's clear that Canadians are feeling the pressure of potential higher mortgage rates. Almost half of homeowners renewing their mortgages in the next year anticipate larger payments. Steve, what do you think is causing this widespread concern?
Steve, well, Sandy, many of these mortgages were initially taken out during the pandemic when interest rates were historically low. Now, with rates still higher than they were a few years ago, despite some recent declines, Canadians are bracing for increased financial obligations.
Sandy, the survey highlights that 73% of those polled are planning to cut back on expenses to meet their mortgage payments. That's a significant portion of the population making lifestyle adjustments. What kind of expenses are people cutting back on, Steve?
Steve, a large portion, 43%, are considering putting a hold on home renovations, which makes sense given that residential renovation costs have increased across Canada, except in Ontario. Additionally, 29% are planning to sell their homes and downsize, while 15% are looking at moving to more affordable neighborhoods or sharing their homes with roommates.
Sandy, it's interesting to see how these financial pressures are influencing decisions beyond just housing. Patrick Smith from TD pointed out that economic uncertainty and global instability are adding to financial anxiety. It seems like a lot of Canadians are reevaluating their financial priorities.
Steve? Absolutely, Sandy. Beyond cutting expenses, 55% of those looking to buy a new home are also reducing unnecessary spending. Some are even considering cashing in investments from their tax-free savings accounts and registered retirement savings plans to fund their purchases.
Sandy. And when it comes to mortgage types, there's a strong preference for fixed-rate mortgages over variable ones. Three-quarters of those surveyed are leaning towards fixed rates for the predictability they offer, especially in uncertain times.
Steve, that predictability is crucial, Sandy, especially for first-time homebuyers or families with tight budgets. While variable rates might offer lower interest, the security of fixed rates seems to outweigh the potential savings for many right now.
Sandy, it's also notable that only 35% of surveyed individuals have sought advice on homeownership, yet 39% said quick access to professional advice would boost their confidence in their decisions. There's clearly a gap in information and support.
Steve, indeed, Sandy. As Patrick Smith mentioned, understanding the complexities of home buying and mortgage renewal is crucial. People need tailored advice to navigate these financial waters effectively, and it seems there's a significant opportunity for institutions to provide more accessible guidance.
The Canadian housing market is seeing some dramatic shifts, Steve. A recent analysis by the Canada Mortgage and Housing Corporation indicates that housing starts for Canadian homeowners are set to hit a 30-year low in 2025. At the same time, rental unit starts are at a record high. What do you make of these trends?
Sandy, these figures are quite telling of the current state of the housing market. The CMHC data shows that from January to October 2025, there were only 41,384 homeowner housing starts in towns and cities with populations over 10,000. This is the lowest annualized rate since 1995. Meanwhile, rental starts have reached an annual record high with 87,971 units within the first 10 months of the year, which is projected to reach 105,565 by the end of 2025.
It's clear that the focus is shifting towards rental properties. Mike Moffat from the Missing Middle Initiative pointed out that purpose-built rentals have become more profitable than high-rise condos. Plus, there are significant barriers to building ground-oriented housing like single detached homes due to high taxes, development charges, and land use policies.
Absolutely, Sandy. And this shift is influenced by both market forces and policy measures. The federal government has eliminated the goods and services tax on purpose-built rentals and created an accelerated capital cost allowance for rental construction. These policies make rental development more attractive to builders.
But while the rental market is booming, the dream of homeownership seems to be slipping further out of reach for many Canadians, especially millennials and Gen Zers. Moffat emphasized that home prices have dropped, but they still don't cover the cost of construction, making it unprofitable for developers to build new homes.
That's a critical point, Sandy. The average home price in Canada has dipped to $679,900, a significant drop from the peak in March 2022. Yet the cost of construction remains high, and financing is challenging. This has led to a decline in home sales, particularly in major cities like Toronto and Vancouver.
And with the current economic pressures, Canadians are spending a large portion of their income, 35 to 50%, on housing and utilities. This is pushing more people towards renting as a more feasible option. The demand for rentals is also driven by record levels of immigration and a growing number of young Canadians who can't afford to transition to home ownership.
Exactly, Sandy. The government's policy focus on rentals has helped meet this demand, but it raises questions about the long-term economic and social impacts. If homeownership continues to decline, it could affect wealth accumulation and stability for future generations.
Prime Minister Mark Carney introduced several policies aiming to tackle the housing crisis, like the first-time home buyers GST rebate and a Build Canada Homes Agency. However, Moffat noted that these measures haven't fully delivered, particularly in terms of reducing development charges and offering tax incentives for smaller apartment constructions.
Indeed, Sandy, it seems that while some initiatives are in place, there's still a gap in effectively addressing the housing supply issue. As Moffat mentioned, without addressing the cost issues, we might face a period where construction slows even further, leading to increased demand and limited supply when the economy rebounds.
The condo market in Toronto is in a bit of a bind right now, Steve. Recently, a court ruling canceled sales agreements for over 300 buyers at the One Bloor West Tower, which has been in receivership since 2023. These buyers are getting their deposits back, but it's a sign of the ongoing issues in the city's condo market.
That's right, Sandy. These buyers have been offered the chance to purchase again, but many are likely relieved to walk away. With the condo market in decline, the return of their deposits might seem like a blessing. The rise in interest rates since 2022 and a reduction in immigration targets have really taken a toll on rental demand and condo values.
It's interesting to see how quickly things have shifted. Not long ago, condos in Toronto were seen as a foolproof investment. Investors could buy, rent out, and enjoy rising property values. But now, with rates climbing and rental demand dropping, the situation has flipped.
Indeed, Sandy, the sharp increase in interest rates post-COVID, along with revised immigration policies, has reshaped the landscape. Rachel Battaglia from RBC pointed out that these changes are slowing population growth, which in turn eases rental demand and affects housing markets.
And with the decline in condo values, many buyers are struggling to secure mortgages for their original purchase prices. This is causing headaches for landlords and investors who are stuck with properties that are bleeding cash and difficult to rent or sell.
It's a challenging situation, Sandy. Some investors are even cutting their losses and walking away, despite the legal risks involved. The potential for a surge in mortgage delinquencies is a concern, but market watchers like Aled Abyorworth from CMHC suggest it's not yet a crisis.
That's a bit of a silver lining, Steve. Although delinquencies have increased by 60% year over year, they remain relatively low at 0.24% of all mortgages in Toronto. Iorworth emphasizes that while the increase is notable, it's not an immediate cause for panic.
CMHC also notes that while demand for condos is down, the drop in housing starts could eventually put pressure on supply. This might lead to a rebound in the market a few years down the line, though the current economic outlook remains uncertain.
It's a waiting game, really. Yorworth believes it will take time to sort out, but he raises concerns about future shortages. As housing starts for apartments are expected to fall, we might find ourselves dealing with a supply crunch in a few years. Steve, there's been a significant surge in mergers within the mortgage industry, reshaping how alternative lenders operate. What's driving these mergers, and what impact could this have on brokers and borrowers?
Well, Sandy, it seems the driving forces behind these mergers include regulatory complexities and intense competition in a somewhat cooling mortgage market. Smaller lenders find it increasingly difficult to compete without scale, and the recent merger of Fairstone Bank and Home Trust, as well as Nesto Group's partnership with Maple Financial, are prime examples of how companies are joining forces to stay competitive.
That's interesting, Steve. Taylor Little, CEO of Neighborhood Holdings, mentioned that the regulatory environment has made it challenging for smaller lenders to compete, unless they have significant scale. With the housing market slowing, competition is fierce, and only those with access to large pools of institutional capital can really keep up.
Exactly, Sandy. And it seems that smaller lenders often rely on private investors, while larger ones can access cheaper funding through programs like the National Housing Act Residential Mortgage-Backed Security. But, with recent rule tightening by the Canada Mortgage and Housing Corporation, it's become even more restrictive, pushing more borrowers into the alternative lending space.
So Blake Dumely from Nesto pointed out that big banks prefer funding mortgages with deposits and internal sources, rather than using RMBS. This gives alternative lenders with enough scale an advantage if they can tap into these lower-cost funds.
And with compliance becoming a full-time department, as Rafer Strandland from Fiskard Asset Management mentioned, smaller companies struggle to afford the necessary resources. This makes mergers a strategic move for survival and growth.
It sounds like a challenging environment, Steve. Daniel Webster from Maple Financial noted that their partnership with Nesto Group gives them a national reach, which many regional players can't match organically. This kind of consolidation could change the competitive landscape significantly.
True, Sandy. However, Ryan Sims from TMG cautions that less competition often doesn't bode well for brokers and borrowers. Fewer players might lead to higher prices and less choice, although there's hope that consolidation could result in more diverse products and services.
It's a double-edged sword, isn't it? While consolidation can drive innovation and efficiency, it also risks reducing competition. Sims is skeptical, but acknowledges that the trend of mergers isn't over yet, and we might see more unexpected partnerships in the coming months.
Indeed, Sandy. As the industry continues to evolve, it's essential for both brokers and borrowers to stay informed about these changes and how they might affect the mortgage landscape.
Steve, it looks like we've got some mixed news about home affordability across Canada. While there were improvements in October, it seems these gains might not last long. RateHub.ca highlighted that 10 out of 13 major cities saw a drop in the required income for purchasing an average home. What do you make of this?
It's interesting, Sandy. The improvements were largely due to slight declines in home prices, rather than changes in mortgage rates. Penelope Graham from RateHub.ca pointed out that the 5-year fixed mortgage rate held steady at 4.47%, so it's really the price adjustments driving these changes.
Vancouver, for instance, saw the largest gains, with home prices dropping by $9,600, reducing the income needed for a mortgage by $1,800. And Hamilton saw similar trends, which is quite significant for potential buyers in those areas.
Yes, but not all cities experienced this improvement. In fact, places like Fredericton saw affordability worsen, with home prices increasing by $7,500. This drove up the required income and monthly mortgage payments. It's a reminder that the housing market isn't moving in the same direction everywhere.
And with the Bank of Canada suggesting that October's rate cut might be the last for a while, buyers looking for relief from high mortgage rates might not see any more cuts soon. The central bank's governing council mentioned the current rate is about right to maintain economic stability.
Penelope Graham advises those in the market to act quickly. The best 5-year fixed rate currently available on ratehub.ca is 3.79%. Locking in a lower rate could mean substantial savings, particularly with the average national home price sitting around $690,195.
And although Canadian home sales saw a slight increase in October, the CREA reported a modest 0.9% rise in activity. This suggests many buyers are still cautious, likely watching to see how economic factors play out, including the ongoing trade discussions between Canada and the United States.
Annalise Cugliari-Allegritti from Royal LePage mentioned that the sluggishness in sales activity indicates buyers are holding back, waiting for more economic clarity. It's a complex situation, and navigating it requires being well informed about current mortgage rates and housing market trends.
Steve, the Office of the Superintendent of Financial Institutions has proposed some significant changes to the capital rules for financial institutions, aiming to boost lending and competition in the banking sector. What can you tell us about these proposed changes?
Well, Sandy, OSFI is looking to relax capital requirements, which could enhance lending capabilities and increase competition. They're focusing on land acquisition, development, and construction exposures, specifically in the residential development space. The proposal includes lowering the base risk weight for low-rise residential real estate from 150% to 130%, and introducing a 90% risk weight for ADC projects where pre-sales equal or exceed 75%.
That sounds like a strategic move, Steve. Superintendent Peter Routledge mentioned that adjusting these rules could incentivize banks to lend more to smaller businesses, potentially boosting productivity. This comes at a time when the concentration of lending power among major banks has been criticized.
Exactly, Sandy. Routledge highlighted the regulator's responsibility to enable smaller institutions to compete more effectively. He questioned whether the current allocation of bank capital is truly beneficial for Canada's long-term prosperity and productivity. By lowering risk weightings for corporate small and medium-sized business exposures, OSFI aims to make credit more accessible across various sectors.
It seems like a delicate balance between risk and flexibility, Steve. The proposed changes aim to reduce unnecessary burdens on financial institutions while maintaining their safety and soundness. The federal government has even endorsed this approach in its recent budget announcement, labeling it as unlocking capital.
That's right, Sandy. The consultation on these changes will conclude in February 2026, with the final guidelines expected in September. Depending on fiscal year ends, implementation could start as early as November 2026. For those in the mortgage industry, this could mean improved financing conditions for residential development projects, especially those with strong presale positions and lower loan-to-value ratios.
However, it's important to note that macroeconomic headwinds remain a concern. While these changes could provide some relief, the broader economic environment will still play a crucial role in shaping the outcomes.
Absolutely, Sandy. It's a complex landscape, and the proposed changes are just one part of the puzzle. Staying informed and adapting to these regulatory shifts will be key for both financial institutions and borrowers alike.
All right, Steve, let's wrap up today's episode with an intriguing development in the real estate regulatory landscape. Industry veterans are urging the provincial government to take control of the Real Estate Council of Ontario, or RECO, following a scandal that has rocked the organization.
That's right, Sandy. The Public and Business Service Delivery and Procurement Minister, Stephen Crawford, has given RECO a tight deadline of 15 days to respond to the official notification that he plans to appoint an administrator to replace its current leadership. This decision stems from a damning audit report by Dentons on the iPro Realty scandal.
The scandal involved the alleged illegal withdrawal of $10.5 million from the former trust accounts of iPro Realty. The company managed to pay back $3 million, and its co-founders, Rui Alves and Fede Colucci, agreed to never apply to certify a brokerage or service brokers again. Interestingly, they were neither fined nor charged, which has raised some eyebrows.
It's a complex situation, Sandy. Brandon Rhee, an Ottawa realtor, highlighted in the Toronto Star that the Dentons report points to a deeper issue within RECO's governance model, where too much discretionary power is concentrated in one office without adequate oversight mechanisms.
And some industry professionals, like Toronto-based mortgage broker Ron Butler, are skeptical about the narrative that one person could have kept such a significant financial breach hidden from an organization with 170 staff members. Butler is calling for the replacement of RECO's board members with the proposed administrator.
RECO has alleged that the former registrar, Joseph Richer, acted independently in delaying the shutdown of iPro and deciding not to penalize Alves and Colucci. However, the Dentons report suggests a poor organizational culture where employees felt intimidated and disempowered to challenge Richer's authority.
But not everyone agrees with that assessment, Steve. Lawyer and real estate broker Nicole Katef expressed surprise at the report's findings, noting her experience with Richer as collaborative. She questions which employees were interviewed for the report, suggesting it might not reflect the views of those who worked closely with Richer.
The Toronto Regional Real Estate Board and the Ontario Real Estate Association have shown support for the province's plan to appoint an administrator, which suggests a potential shift in how RECO might be governed moving forward.
It's certainly a pivotal moment for Ontario's real estate governance, Steve. As the situation unfolds, it will be interesting to see how this impacts the overall regulatory framework and the confidence of stakeholders in the industry.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.